Good morning to both of you. David, how persistent do you think inflation is going to be? And take us inside the mind, if you could, of Jay Powell and how you think he's thinking about it.
I think inflation is going to be coming down because a lot of the supply side problems are easing. The price of shipping a container across the Pacific has come down. Used car prices have fallen for 5 months in a row. Housing prices are beginning to soften. But I don't think it's going to come down fast enough for Jay Powell to relax. I think Jay Powell very much wants to avoid being seen as the Fed chair who let inflation get out of the bottle. He doesn't want to be the guy who undid all the progress that has been made since Paul Volcker's years. So I suspect, they pretty much have baked in another 75 basis points, and I suspect they'll go higher because I think he wants to err on the side of doing too much rather than too little.
Joel, what do you think?
Well, I think that throughout all of this, it's unfortunate that the chair of the Fed, Chair Powell, has not accepted responsibility for the situation we find ourselves in. Were it not for the Fed printing trillions of dollars to fund the explosive growth in federal spending under both Presidents Trump and President Biden, we would not be having the inflation that we're experiencing today. And even if those inflation rates ease off of those 40-year highs that we saw last year and come back down to, say, 4 or 5%, that does nothing to relieve the pain of the middle class that now have seen their real wages decline by more than $6,000 over the past 2 years.
David, do you think that he needs to take more responsibility? And what does that mean?
I think he's actually been, by Fed chair standards, fairly candid. When he spoke at Brookings a few weeks ago, he said flatly, we made a mistake. We should not have said that we would keep interest rates low despite falling unemployment until inflation started to pick up. So, yeah, I mean, the guy hasn't exactly gone out there and flagellated himself, but compared to, say, Alan Greenspan, who I think admitted one mistake in 20 years as Fed chair, I think he's done that. I agree, though, that when we do the anatomy of what went wrong here, that the Fed was slow. They didn't react when fiscal spending was a lot more than they had anticipated. And I think that's going to be a factor now. I suspect the last burst of federal spending, the stuff that recently passed, will add another 0.25 percentage point to the Fed's terminal rate.
Joel, you satisfied with that response?
I know, because if you go back over the past 2.5 years, it was the Federal Reserve coordinating very closely with Congress, with President Trump, and with President Biden to ensure that the explosive growth in spending on the federal level would be financed by the Federal Reserve, printing trillions of dollars to purchase government bonds, and of course to also inflate the housing market by purchasing trillions of dollars in mortgage-backed securities. The primary issue here is not that the Federal Reserve has reacted too slowly by raising interest rates, it's that they actually worked hand in hand with Congress in a disastrous manner that ensured that we would have this huge burst of inflation that we experienced in 2022. This was forecast by many, not just free market economists, but also by President Obama's former top economist, Larry Sumner. So for the Fed to refuse to acknowledge their role in this because of all the money printing, that is a travesty.